You open your investment account late at night. You see a sea of bright red numbers. Your stomach drops. You feel completely overwhelmed. Every single day, the internet screams at you. Buy this new coin, sell that fund. A giant market crash is coming tomorrow. You don't know who to listen to anymore. Somewhere in the back of your mind, you're convinced the answer is out there. One more newsletter, one more YouTube video, one more stock pick that finally cracks the code. You just haven't found it yet. You feel like you're losing a game you don't even know how to play. We call this the capital trap. You think you're losing because you don't have a secret formula. But the richest investor in modern history has access to the exact same information you do. He reads the same news. He looks at the same public charts. He didn't beat the market with more money, more education, or some private army of analysts crunching numbers in a back room. He had access, same as you. That's the part that should bother you a little. Hedge funds spend millions of dollars a year on research teams just to find a tiny edge. Buffett's edge was something a teenager with an internet connection could theoretically copy for free. Here's the question worth sitting with for the rest of this video. If Buffett had the exact same information as everyone else, why did he become Buffett and almost nobody else did? So why did he become a billionaire while most ordinary investors lose money? His biggest advantage isn't raw intelligence. It isn't a secret stock pick. It isn't guessing the future. It's something much simpler. Something almost anyone can do. It's not a complicated formula buried in a textbook somewhere. The strange part? Most people completely refuse to do it. Not because it's hard to understand, because it's hard to make them feel exciting. Most people think wealth comes from brilliance. They think you need a massive IQ to win. They think you need to find the next hidden tech giant before anyone else does. Maybe you assume he had some private edge, a friend on Wall Street, insider knowledge nobody else could access. But that's a lie. This is where we fall into the intelligence trap. We try to beat the market by being the smartest person in the room. Maybe the problem was never that you weren't smart enough. Maybe you've been solving the wrong problem this entire time. Most of us assume the gap between us and someone like Buffett is intelligence, or some rare genetic talent for reading markets. What if the gap was never intelligence at all? What if it was simply behavior, repeated patiently for decades? Look at history. In 1999, everyone was buying internet stocks with no earnings. People made fortunes in days. Buffett looked boring. He bought nothing. People called him old and washed up. Then the market crashed. The geniuses lost everything. Buffett was perfectly fine. He did the exact same thing during the panic of 2008. He didn't run. He didn't panic. He just stayed calm. He did it again in March of 2020, when the entire stock market dropped faster than at any point in modern history, and the news told you the world was ending. Buffett didn't sell a single share out of fear. The average investor loses money trying to look smart. Buffett makes money by staying calm. To fix your system, you have to understand how the market actually works. Imagine a strange man stands outside your house every single day. On Monday, he yells, "Your house is worth $1 million. On Tuesday, he screams, "Your house is worth $300,000. On Wednesday, he shouts, "Now it's worth $800,000. Would you pack your bags and sell your home just because he had a bad mood swing? Of course not. You know your house didn't change overnight. The man with the megaphone is just crazy. Yet investors do this every single day with their stocks. The stock market is that man with the megaphone. It throws wild prices at you to provoke an emotion. It wants you to feel fear. It wants you to feel greed. The market's greatest weapon isn't price drops. It's your emotional reaction to those drops. It's 11 at night. You're lying in bed and you open the app one more time before sleep. Your portfolio is down 6% today. Your thumb hovers over a button you've never actually pressed before. You close the app instead. You don't sleep particularly well. Now picture a different version of that same night. Same 6% drop, same scary headline. This time, you look at the number, feel the same flash of fear, and just close the app. Not because you don't care, because you've already decided in advance that you're not going to make a permanent decision based on a temporary mood swing. This brings us to the centerpiece of his whole wealth system. Rule number 1, never lose money. Rule number 2, never forget rule number 1. But let's look closer. What does that actually mean? It doesn't mean your account will never show a red day. It means you must avoid permanent losses. Here's the difference in real numbers. Say you put $10,000 into a solid company and the price drops to $7,000 during a rough year. On paper, you're down $3,000, but you haven't actually lost anything yet. Not really. Not unless you sell. The moment you panic and sell at $7,000, that paper loss becomes permanent and real, locked in forever. The market didn't take your $3,000. You did. It sounds almost too simple to be the secret behind one of the largest fortunes ever built through investing. That's exactly why most people walk right past it. Ordinary investors chase hype. They buy risky stocks because a friend got rich. Then the price drops, they get scared, and they sell at a loss. The money is gone forever. You just took a permanent hit because you made a stupid decision. This is speculation dressed up as investing. Remember the meme stock frenzy a few years back, when a struggling video game retailer's stock price multiplied overnight because of a few viral posts online? Thousands of people bought in at the absolute peak, certain they'd found the next big thing. Most of them are still holding shares worth a fraction of what they paid. Buffett's first rule isn't really about money at all. It's about behavior. Avoid stupid decisions. Avoid emotional decisions. Avoid pure speculation dressed up as conviction. Buffett doesn't win because he finds more winners. He wins because he avoids more losers. Let's look in the mirror for a second. Why do most people lose money? A research firm called Dalbar has tracked this exact pattern for more than 2 decades now. Year after year, the finding barely changes. The average investor consistently captures only a fraction of what the market itself actually returns. Not because the market failed them, but because their own timing did. Why? Because of basic human nature. Your coworker mentions a coin that tripled in a month. Your cousin posts a screenshot of a stock that's up 40% this week. You feel that specific itch, the fear of missing out on something everyone else already figured out. So you buy in, right near the top, right when the excitement is loudest. We buy when we are excited and prices are high. We sell when we are terrified and prices are low. We do everything exactly backwards. Financial planners have a name for this. They call it the behavior gap, the difference between the return an investment actually produces and the return the investor walking away with it actually gets to keep. That gap is almost never caused by a bad fund. It's caused by a person clicking buy and sell at exactly the wrong moments. Compounded across 20 or 30 years, a gap of even a few percentage points a year isn't a rounding error. It's a difference between retiring comfortably in your 60s and still working well into your 70s, wondering where all those years of contributions actually went. That's not a hypothetical. That's the documented, repeated outcome for the average person investing in the average fund, decade after decade. You don't lose money because the economy is bad. You don't lose money because the system is rigged. Most people don't lose to the market. They lose to themselves. So, how do we turn this around? We have to understand the timeline. Buffett always says his wealth is like a snowball. Imagine packing a tiny ball of snow by hand. You push it along the ground. For the first 3 years, nothing happens. It looks pathetic. Your hands are freezing. Your friends are driving nice new cars, and your snowball is still the size of a pumpkin. This is the grueling phase. It feels like a total waste of time. This is where the fake online gurus promise you a quick cheat code. They lie to you. Let's use some radical honesty. For the first few years, building real wealth is incredibly boring. But if you stay disciplined, you finally reach the edge of the hill. Gravity takes over. Suddenly, the math explodes. The biggest returns always happen at the very end of the timeline. The snowball never looks impressive until it's already massive. We call this second stretch the momentum phase, the part where years of invisible effort finally become impossible to ignore. Nobody sees the years of pushing a tiny snowball through frozen mud. Everybody sees the avalanche at the bottom of the hill and assumes it happened overnight. Most people think investing is an action sport. They think you need to sit in front of 6 screens, trading stocks every single hour. Buffett thinks investing is a waiting game. He bought into Coca-Cola back in 1988, and he hasn't sold a single share since. He built his stake in American Express decades ago and just sat on his hands through every dip along the way. He bought into Apple starting in 2016, years after most of Wall Street had already decided the easy money was gone, and it turned into one of the most profitable single decisions of his entire career. He doesn't fiddle with his portfolio. He doesn't check the price every 5 minutes. The average investor is trying to get rich by next Friday. Buffett is trying to stay rich forever. True investing skill isn't knowing what to buy, it's knowing how to wait. While other investors were trading in and out a dozen times a year, convinced they found the next clever move, Buffett was doing almost nothing for decades at a time. Doing nothing, on purpose, turned out to be worth billions. He's been asked literally thousands of times in interviews for his secret. The answer never changes, and it's never satisfying to people looking for a shortcut. Be patient, and don't do anything stupid in the meantime. That's the whole interview, condensed into 11 words. Reporters keep waiting for something more complicated. It never comes. Let's bring everything together. The real secret to wealth isn't a better stock picking tool. It isn't a higher IQ. It isn't predicting the next recession. The secret is building a system that protects you from your own brain. If you don't learn to control your emotions, the market will use your own mind to destroy your savings. The greatest risk to your portfolio isn't the market, it's emotional decision making. So here's the answer to the question we opened with. Buffett had the exact same information as everyone else because information was never the advantage. The advantage was a system built to keep his own emotions out of the decision. That's available to literally anyone willing to build it. Most people just never bother. The capital trap and the intelligence trap were never really about lacking information or lacking genius. They were both just expensive disguises for the same root problem: an unprotected mind making decisions under pressure. So here's your challenge for the next 30 days. Stop looking for the next hot investment. Stop checking the daily price jumps on your phone. Turn off the financial news alerts. Instead, ask yourself a question. What is the one emotional habit that's costing me the most money right now? Is it panic selling? Is it buying hype? Fix that one behavior, because fixing your own system will do more for your wealth than finding the next winning stock ever could. You didn't come here to find one more hot stock tip. You came here because some part of you already suspected the next great investment wasn't actually the missing piece. The missing piece was a system that keeps you from sabotaging yourself. Build that, and you won't need to chase anything ever again. 30 days isn't long enough to get rich. It is long enough to finally notice the one pattern that's actually been quietly costing you money this whole time.